Let's just get into our portfolio hedge decision tree. As always, we'll start with our fundamental inputs and our macro catalysts. So quite a bit going on over the next, let's call it, 4 to 6 weeks. We'll start on the growth side on the 29th of this month. This Friday, we got the PC report here in the U.S. Next week, we have the ISM manufacturing on the 1st, the JOLTS report on the 2nd, the ISM services report on the 3rd, followed by the jobs report on the 5th of April. And then the next critical growth data point that we see on the horizon beyond that will be, again, the PC report on April 26th. In terms of inflation, we have the PC report. We'll get the inflation indicators out of the PC report this Friday on the 7th of next month. We have Japan's wage data. Recall that the wage component has been really the driving feature of BOJ policy and their newfound move, their recent exit from NERP, negative interest rate policy, and their recent decision to end yield curve control, albeit still with a very accommodative policy stance. They're continuing to buy bonds, and obviously interest rates are still extremely low, certainly relatively way lower than they probably should be when you look at things like Taylor rule spreads or just the general level of Japan's nominal GDP. In terms of sticking with inflation, on the 10th of next month, we have CPI report here in the U.S., followed by the PPI report here in the U.S. on the 11th. And then we have Japan's CPI report on the 18th of next month, followed by the PC report here in the U.S. Again on the 26th of next month. And then lastly, with respect to policy, the ECB's up next on the 11th of next month, followed by the BOJ on the 26th, followed by the Fed on the 1st, and then followed by the Bank of England on the 9th of May. So quite a lot going on from a macro catalyst standpoint. So, in terms of, from our perspective, the things that have the biggest opportunity to create havoc or create a decent amount of volatility and upset the apple cart with respect to the risk on market regime are obviously the U.S. and Japan inflation reports, followed by those the central bank meetings at those particular geographies. In terms of geopolitical catalysts, nothing we're really flagging in terms of our research process that seems to be particularly meaningful. Anything on your side, Imran?
No, not on the geopolitics. More just on the option side. Seasonality's usually quite big going into Easter for vol to come down. Mm-hmm. So we've seen all cross-asset vol get completely annihilated, right? There's a few little pockets in commodities that are moving around, but generally all vol is getting hammered. And it felt as well that post FOMC, we got our little vol reset as well. And it seems like whilst all these macro data points that are upcoming, if you look at the term structure of the S&P, the front end of the curve is trading much cheaper than it normally would. So like the plus stuff is kind of trading kind of effect, but the front end's really been compressed hard. And I think it's because of the way implicitly the FOMC kind of showed us that they were comfortable with inflation ticking back up in predictions for the end of the year and still holding 3 cuts in there on their dots, kind of de-risks a lot of the macro data for the next month or two, because it's like, what is their reaction function? Like, what's it going to take for them to move the dots materially and therefore move the market? So that's why I think the S&P vols are just reflecting that and getting hammered.
100%, my friend. We agree. So shifting gears to our quantitative inputs in terms of our macro weather model and our global macro risk matrix. The weather model suggested the risk on market regime, which is currently reflation, has a middling probability of surviving over the next 3 months. When we layer on, again, as I mentioned, our fundamental research, we think that we are probably likely to have a risk on market regime condition persist into the third quarter of this year. That's when our fundamental research suggests that we may see a negative trend emerge in U.S. and global liquidity. But again, it's late March here, so let's not get ahead of ourselves. So no real need to be concerned about that today. In terms of our crowding, dispersion, and positioning model, we continue to see elevated pain trade risk from the perspective of our positioning model, albeit a lot less pain trade risk than we've observed, going back to February and early March. So I would say it's probably an X as well. And then with respect to probable ranges, no key macro factor is overbought, oversold in a way that would be very hazardous to the current setup within the context of the KISS portfolio construction process. So, just on the macro catalyst side, we're really seeing some risk there. But again, just from a fundamental standpoint, we're not seeing a material amount of risk that could cause a trending market correction and a trending reversal of factor leadership until sometime in Q3. That's our current expectation. That could always change, and we'll be very loud and communicative about any such changes if they happen sooner than we currently anticipate.